Hello and welcome back to another video with Mind Money Masters. I'm Cameron and I'll be your host today as we continue to delve into the world of mutual funds. Now, mutual funds are such a large topic and highly in conversation today that I wanted to split them up into two videos. Today we talk about investing in mutual funds and things to look out for when selecting mutual funds, and also how to select the best mutual fund for you. This video goes into more of the tangible items that will take you when you need to talk to your advisor or when you start investing into mutual funds. Thank you so much for your support, and please remember to subscribe to my channel and comment in the feed below if I can talk about anything in particular regarding personal finance, investing, or making money online. Let's get started. Hey, once again, thank you so much for watching. Just as a point of disclosure, all of my opinions are solely mine and not any form of professional financial advice, as I am not a licensed advisor. Please work with your professional advisor before making investment decisions. Now, that being said, are mutual funds safe? That's a really loaded question because most financial advisors would say yes, because they, quote unquote, are diversified. Well, what does that actually mean? Supposedly, it means that the investment risk is spread out among several companies so that if you see one go down in value, the entire fund does not go tanking in value. Well, that still doesn't help if the entire stock market goes down in value, now does it? Plus, there's no actual protection against falling mutual fund prices, or the net asset value as it's commonly called, except to just sell the fund at whatever loss may happen that day. You see, this is because mutual funds trade only once a day at the end of the day. So if you see the market going down, you cannot get out of the fund until the market closes for the day. Now, this can help against a knee-jerk reaction to sell, so you don't sell too soon, but on the flip side, there's no way to control your losses other than buying multiple different funds. Now, since the general understanding for mutual funds is to buy and hold the fund over time, history has shown us that there is a consistent return on the stock market, at least for the past 30 years. Now, what I'm trying to tell you is that, safe is a misnomer. It depends on what you actually understand as safe investment to be. More on this in my last slide in the final take. Lastly, the safety of your investments can also depend on your risk profile. I have 3 examples up there that talk about, there's really 5 examples, but the 3 examples most common are conservative, moderate, and aggressive. Now, conservative is a place where you really want to limit any exposure to volatile markets. Now, moderate is half conservative and half aggressive. Aggressive is looking for the most volatile and risky investments you can. With anything, the higher the risk, the higher the potential reward, but managing risk with mutual funds is extremely difficult, as we mentioned earlier. Now, again, I will go more into this on my last slide in the final take, so stay tuned for that slide. Another aspect of investing in mutual funds are the fees and taxes. Now, make sure to consult your advisor before making any serious buying decisions, because mutual funds can carry many fees and taxes. Now, the fees may be called a load, an expense ratio, 12b-1, or distribution fees, commissions, redemption fees, short-term trading fees. The list can go on. You should ask your advisor what are all the fees associated with this mutual fund that you're looking at. Now, typically, a lower cost fund would be an index mutual fund that seeks to track an existing index, similar to what an ETF does, or an exchange-traded fund. Those would give you good exposure to the overall market and typically have low expenses. I like to see expense ratios less than 0.50%. Obviously, or lower is always great, but an excellent book on learning more about the fees associated with mutual funds and 401ks in general, if you're familiar with that, would be the book Money, Master the Game. It's by Tony Robbins. I will put the link in the description for you, but it's a fantastic read regarding, I think it's one particular chapter, it might be chapter 7 or chapter 8, that talks specifically around mutual fund fees and how many fees are in there. It's almost mind-boggling. Oh, excuse me. Also, you may have taxes on any capital gains and dividends, even if you do not sell the fund. We discussed this a little on our first video from mutual funds that you may have missed. If you missed that video, go back and check it out. That's just kind of the beginning basics for mutual funds. Now, make sure that you understand what would be the ramifications of any taxes on dividends or capital gains. Now, when you start your research to select a mutual fund, you will likely see the Morningstar rating. Now, the Morningstar rating bases their review on multiple factors, but they give a star rating of 1 to 5, 5 being the quote-unquote better fund. You will typically be able to see this if you ask your advisor what the Morningstar rating is for this fund. Mutual funds will typically use an index as their benchmark, or what they are trying to beat as far as the return. So if an index, or if a benchmark is returning close to 10%, the mutual fund company is trying to beat that 10% by 11, 12, 13%, or what have you. Usually, the S&P 500 is a benchmark for a total stock market fund. This will change when you look at any other specialty funds or look at bond funds. Like we talked a little bit about commodities and real estate as also being in the category of potential other fund options. You also want to look at what a mutual fund invests in, or the portfolio holdings. Find out how much international exposure there is, or if they are overweighted in a highly speculative category. When I say speculative, I mean that volatility piece. Ask yourself if you could hold this investment and not worry about any crazy fluctuations. Now, of course, the moment we've all been waiting for, my final take. Oftentimes I take more time on this slide than all the others combined. I will try not to do that today, but I wanted to give you some food for thought. When you say mutual funds, or when they say, the financial gurus out there say mutual funds are diversified, that's not really true. Diversification needs to be spread across asset classes, not within one individual asset class. So if you have a mutual fund that invests in 500 companies in the stock market, that is just spreading your risk among those 500 companies. But if the market goes down, all 500 companies go down. You see? Now, if you had a real estate fund or real estate investments and holdings or commodity investments in the commodities fund, then your holdings would be a little bit better spread out and actually could be diversified. Since if the stock market crashes for whatever reason, that doesn't necessarily mean that other asset classes would crash. Also, when you hand your money over to a money manager, you give up control. Now, I don't really like that. I would rather learn how to manage my own assets and create my own wealth. Not that I'm anti-financial advisors, but you should always take responsibility for your own future. When you give over your money to someone else to manage, you take all the risk. You take on all the risk and get little of the reward. I use the 95-5 example or the 80-20 example, but this example in 95-5 is 95% of the risk is on you and you only get 5% of the profit. Think about it. When they are using your money to invest however they want, but if they don't make a return on your investment, you still get charged fees and you lose money in your investment. Now, they may blame the market for not acting the way that it was expected, but what acts the way that it's expected? We should always plan for this. They also explained that the long-term game is the way to play with mutual funds. So you need to leave your money in for a long time. And since the market has, on average, returned 9% returns over the last 30 years, there is some semblance of truth to that. However, that's not really always the case if you calculate taxes and other returns. You got to look at all the fine print associated with that number. However, when you invest in mutual funds, there is no way to manage risk like you would if you invested in stocks or ETFs alone. There are options that I will talk about probably in another video that will help you manage your risk of those investments. The only way to manage your risk in a mutual fund is to buy more funds, which is really counterproductive because you're just spreading your risk over other areas, and it almost seems like you could spread yourself so wide that you don't make any return. So, regardless of whether you invest in mutual funds or not, the only piece of the puzzle, they are only one piece of the puzzle for financial freedom. Now, you need to consider all 4 areas of the asset class. We talked about 3 of them today. Paper assets, which are including stocks, bonds, ETFs, and mutual funds. Another one is commodities. Commodities is another section of the asset classes. And real estate. Those three make up 3 out of the 4. The last one is owning your own business. You need to invest in yourself where you aren't required to trade time for a paycheck every day until you retire. That paycheck that gets dumped into a mutual fund that ultimately someone else manages and then you lose value from, how is that going to create future value for yourself? If you are interested in starting your own digital business, I have an amazing program that is linked in the description. So please, please, please check it out. It doesn't take any time. It's about a 5-10 minute video. Check it out. It's an amazing video from an amazing guy. Thank you so much for watching my video. I really, really hope you enjoyed it. And remember to please subscribe to my channel and comment below on what you liked or didn't like and how I can improve. I'm always trying to improve. Cheers to your success and happy investing.